Hey traders, Nick here on Sunday night doing the strategy video for the week. So this is basically the strategic market update, trying to steer us right before we start the action. So let's first start with what happened last week. Extremely bullish week. I'm starting on the small caps because I did say I'm focused on the small caps the last couple of weeks because they are the most hated group on the way down and they have bounced pretty hard. This is 22-23% rally off the bottom almost non-stop. That is a lot. This is a basket of 2,000 stocks. Not only just 2,000 stocks, they were very hated on the way down. Here they are. So let's go back to the S&P. So the bulls are definitely completely in charge. And it's up to the bears to take the reins away from them, which is not going to be easy. So let's start with what's causing this. What's feeding this? We fell on the way down, and I said this correction was harder than anything I've seen in a long time, if ever. So I said these were violent candles. I said expect some violence on the way up and some weird stuff. This is more than I expected, because we took this out. So I thought we would stall here a little bit and dip. I think that would have been better, more normal. Instead, we stalled and just took off. And now we're threatening to take out the April-May highs, which are very sharp, and we shouldn't. I hope we don't, because that just opens the door for another drop, even more violent. So instead of doing all of this and then having months and months of corrections, the proper way to do is to get here, stall a little bit, come back, break out, get to here. So on July 20th, I shared a write-up and video, many write-ups and videos that mentioned the potential target of the SPY at 430. Here we are an inch away from it. In fact, the number I had in mind was 432. So we're almost there. That doesn't mean I said go buy calls. That's why I was looking to buy dips. People saying you're too bullish, you're too bullish. That's because I didn't see the reason to fall, and the right thing to do was to buy a dip, especially of a specific stock falling into support. So this week, what could mess things up? Nothing but sentiment. Nothing has changed. The threats are there. They're exactly the same. The economy, quote, is in a recession. Maybe it's not. Maybe it is. It doesn't matter. The economy is not the stock market. We've had some violent rallies inside recessions. No need to connect the two. Don't put logic that we're in a recession. We are in a recession. We are not in a recession. The shops are full. Amazon is busier than hell. We're spending every dime we make, and there's a lot of money in the economy. Technically, the U.S. is at full employment. Whether you believe in it or not, it is. So the reason why the Fed is so combative is because the economy has never been this strong in this way. So these are weird new scenarios. So don't apply typical logic. Recession, stock market down. It doesn't work that way. So what now? Now, this week, we have CNBC is going to drum up Wednesday as the all-important Fed minutes. Like hell they are important. These are situations that happened weeks ago. The Fed minutes, folks, is not an event. This is when they release the minutes of an event that happened weeks ago. They met. They told us the rate hike was 75 bips. They told us what they want to do forward. They've had dozens and dozens and dozens of public speeches and questions and answer. So we know exactly what they said. Why does everybody get hung up on what the minutes say now of past events is beyond me. But it's coming Wednesday. Expect them to drum it up as the all-important minutes and what we learn from it. We're not going to learn anything new. They already told us. Anyway, besides the point. So Friday we rallied too much. It caused pain for the market maker and myself. I had a credit call spread that went bad. Overall, if I'm managing my book, I'm long enough stocks to make Friday okay. It was disappointing to lose on that one trade, but it happens. So we might want to give back some. So if we dip on Monday, I would take that to fix short positions. So if I was too bearish, and if a dip comes on Monday or Tuesday, I would use it to fix those bearish positions. I don't assume we're going to zero from there. It's hard to short when the bull is this fierce. We need to short eventually because we need a dip, but you can't be too harsh with your opinions fighting the tape. If price wants to go up, let it go up. How do I short? Gently, by selling a call spread way out in time and leaving room for error. So a little bit higher than now, out in time, lets you see it rally a little bit and then fade if that's what you want to do. Make sure your portfolio is balanced. So Monday, Tuesday, we may give back some. It's important to go to a weekly chart to put things into perspective. Did you know that on Friday, we were 10% away from an all-time high? Hard to believe. We were 18% off the low from the S&P, I think 23% for the NASDAQ, 22% for the small caps. That is an insane amount of movement. But look at this. April, May, we had a couple of sharp corrections that had been pivotal. You know, we broke out a year ago, tested it for footing, fought over it, lost it, and now they're coming back to take it back. If they go above 440, that would be sacrilege, but I hope they don't. But you know, don't short it just because. So I've been reading. Thank you for sharing information, everyone out there. So I've been reading other people's opinions, technical guys. It seems like there are two schools of thought battling. One looks for extreme highs and one looks for extreme lows. I think they kind of both come to fruition, but at different times. So we're going to overshoot one way, correct a little bit, try to rally back, and then correct harder. So if we dip early in the week, I think they will buy it. Maybe 25, 30, 40 points maximum, and they'll try to buy it. So that's why I'm saying take advantage of the dips to close the bearish positions that were bad. If you want to swing trade it, maybe it's a buyable dip to try to swing back. And if we rally back and we don't take this out, then the bears might have a chance to get back below 400, but it's going to take a lot of hard work. So a small dip, they will try to rally it back. If they take this out, they will come to here. If they don't take this out, they will come to here, and that's a buyable dip. So you hear the logic? I expect a dip Monday or Tuesday. It won't be deep, and they will try to push it right back. And if they break above Friday, don't short. And if they don't break above Friday, the bears will try to bring it down to here, which will be a buyable dip. Okay, when I say buyable dip, means close your shorts, get long somehow on the S&P, and see if you can make it work. So we went long the IWM before the pop. You enjoyed the pop. Let it run. If you're still long, book your profit somewhere. When it dips, small dip, I wouldn't do anything. Small rally, I wouldn't do anything. The rally breaks out, I would chase. If it doesn't, I will rebuy at a dip. So I would have traded it up, waited for clues to chase it higher, or trade it back from here. These are shorter term comments. What about the longer term comments? So if I'm long a stock, I'm not doing anything. I'm long Palantir, Upstart, or Apple, or whatever. I'm not doing anything. All I do is just book profits where I deem appropriate. Lighten up. Don't be all pointed in one day. You will have a great week and a crappy week after that. What good is that? So if I took stock positions for a trade, I'll stay in them. I'll book them. If I took them for investment, I'll stay in however much I want to hold long term. Bitcoin's perfect example. I said get long Bitcoin when BITO was 12 point something. Let's call it 12.7. I don't remember. It hit 15. It has a lot of upside to go. I personally did not close my position because my commitment was an investment. But if somebody took it as a trade, they can close a lot of it and leave some on to see if they can get that. So that's just a couple of examples. To go all in now in Apple because you feel better about the market is a mistake. To go short Apple because you think the market is overextended with conviction is a mistake. So we should be reactive and actively managing our risks. So this would be like the big picture, nothing specific, just the big picture of what I expect this coming week. I expect the unexpected still, so I shouldn't short just because I hate it, type of a deal.